Now we move to investment appraisal using ARR, that is accounting rate of return. The accounting rate of return method of appraising a capital project is to estimate the accounting rate of return or return on investment that the project should yield. If it exceeds a targeted rate of return, the project will be undertaken. For example, the target ARR might be 20%. So if the calculated one exceeds the 20%, the project will be undertaken, and if it doesn't, it should not be undertaken. The formula for calculating the ARR is given as estimated average profit divided by estimated average investment times 100. And estimated average profit is given as estimated total profit divided by number of years, while average investment is given as initial investment plus salvage value divided by 2. For example, a company has a target ARR of 20% and now considering the following project. The capital cost of asset is $80,000. Estimated life is 4 years. Estimated profit before depreciation in year 1, 20,000, year 2, 25,000, year 3, 35,000, and year 4, 25,000. The capital asset would be depreciated by 25% of its cost each year and will have no residual value should the project be accepted. Now we move to the solution. Profit before depreciation cannot be used to calculate ARR. We have to deduct depreciation from the profits first. The formula for the depreciation is cost minus salvage value divided by number of years. And in this case, we have the cost as 80,000 minus 0. It has no salvage or residual value divided by 4, which is the number of years. And that gives us a depreciation of $20,000. So now we have the profit after depreciation in year 1 as 0, year 2 as 5,000, year 3 as 15,000, and year 4 as 5,000. So now going back to the calculation of the ARR, which is the estimated average profit divided by average investment times 100. So the first is to calculate the estimated average profit, which is the, in this case, which is the profit after depreciation divided by number of years. So that gives us 25,000 divided by 4, and that is $6,250. Estimated average investment, which is cost plus salvage value divided by 2, is 80,000 plus 0 divided by 2, and that gives us $40,000. As a result of these calculations, the ARR, which is average profit over average investment times 100, will now be 6,250 divided by 40,000 times 100 over 1. That gives us 15.625%. The project cannot be undertaken because it would fail to yield the target ARR of 20% set by the company. Please subscribe. The accounting rate of return, which is ARR, has its own disadvantages and advantages. So, of the advantages, 1. It is simple to calculate and understand. 2. It considers all cash flows associated with the entire life of the project. 3. It is a rate of return approach which managers in a divisionalized structure will be comfortable with. 4. As a measure of profitability, project viability or otherwise will be easy to identify. And also the disadvantages of the ARR. 1. This method ignores time value of money by assuming that $10,000 in year 1 will have the same value even in year 10. 2. The method also ignores risk and management attitude towards risk. 3. It makes use of accounting depreciation instead of a more relevant capital allowance. 4. The approach ignores the actual size of the cash flow. 5. The method ignores differences in project ratios. 6. It ignores the impact of inflation on project cash flow. 7. The approach will not consider the effect of working capital on the project viability. Thank you. That's all. And please subscribe.